being optimistic is good for business. It's very difficult to gather assets when you tell people, well, we've got to prepare and hunker down for a possible bear market that could last a long time. It's much better to say, hey, markets are already up whatever percent in the first half of 2025, and the train's leaving the station. You better leave now. You better get on the train and invest your money right now and try to get those returns as much as you can while you can.
Welcome to the Freedom Point Real Estate Podcast, where we talk about creating more time freedom through passive real estate investing. Passive investing in real estate challenges conventional investment wisdom. We are passionate about learning and sharing resources with others who are ready to transform their investing mindset. Quick disclaimer as always, I am not a CPA, I am not an attorney or a financial advisor. This is not financial advice, not telling you or anyone else what to do. The views and opinions expressed in these podcasts are provided for education and informational purposes only and are not necessarily the views of my employer. I'm glad you're here. Now let's dig in. All right, welcome back, Freedom Point Podcast listeners. Thank you again for jumping into yet another episode of the Freedom Point. I'm so glad you're here with us again today. I've got another amazing guest, as I always do. I've got John De Goey. John, welcome to the show.
Thanks for having me, Jeremy.
Yeah, looking forward to chopping it up with you. And, before I get started, John, I'd love for you to maybe unpack a little bit more about kind of your background, specifically as a portfolio manager in Toronto. You wrote a bunch of books, you've had some success in the space, really as more of a financial advisor, I guess, more than anything. So we'd love for you to kind of tell us a little bit more about maybe your background, your journey, what you're focused on today, how you got into the space, et cetera.
Great. So thanks again for asking. It's great. Everyone loves talking about themselves. So I started in the financial services industry almost 32 years ago in September of 1993. Here in Canada for maybe the first year, I had only a mutual fund license by 94. I had a securities license by 95. I had a few designations, and I was learning things and being more proficient in getting more designations, got a CFP and whatnot in the mid 90s and built out my practice. And I would say that an important turning point for me came in 2009 after the global financial crisis. I had been managing portfolios as a traditional advisor with working back and forth collaborative. And we had investment policy statements, which are portfolio blueprints in place, and they had all agreed in writing in advance that they would rebalance their portfolios when stocks were down and you had a chance to reposition some of your bonds to buy more when stocks were on sale. And try as I may, the very large majority of my clients were too scared to do it. And I was frustrated by having gotten buy-in, having even gotten sign off. Clients actually signed off saying they would do it, and then not being able to get them to do it, which caused me to question my ability to act as a behavioral coach. I therefore made the decision in 2009 to become portfolio manager, which makes me a fiduciary. It gives me discretion. It allows me to simply do what needs to be done based on a pre-agreed set of risk parameters that I have to maintain in my client's best interest. So I've been working on that basis since 2009. My career, I've been a portfolio manager. Along the way, I've written, I don't know, maybe 200 articles for the financial press. I've done a whole bunch of TV shows and interviews as an advocate for consumer interests and as a person who tries to bring advisors and investors together to help them better understand how each of them thinks and works to demystify financial advice. And I've written 3 books, the most recent of which is this one here, Bullshift: How Optimism Bias Threatens Your Finances. And that came out a couple of years ago, like 2.5 years ago. And it's about optimism bias and how the industry shifts people's attention to make them feel bullish. So that's quick Cole's notes.
Yeah, no, I appreciate that background, and we'll jump into the bull shift and the stand up and the other book that you wrote as well in just a minute here. But I'd like to put myself under the microscope for a little bit, if you don't mind. You brought up this time period, otherwise known as the GFC, the global financial crisis, right? And I remember back in those days, I was a high income earner, maxing out the 401k, dumping as much money as I could into my, Roth IRA and index funds and, trying to find the next, Tesla, Facebook, Amazon stock. And I'll never forget during the global financial crisis. Things were plummeting. My stocks had lost, 20, 30% of their value. I pick up the phone, and of course, what do? I call my financial advisor and I say, what recommendations do you have for me now? Right. And the financial advisor literally said, Jeremy, I'm hiding under my desk. Well, it was at that moment that I determined, you know what? I fired my financial advisor that day. Okay. And I took investing into my own hands, really primarily through, alternative investment, strategies, specifically in real estate and other asset classes. But the reason why I'm asking you this question, John, is I'd love to get your feedback. What type of feedback would you give to me as an investor, back during the global financial crisis, to really calm me down and to give me some more, maybe the confidence, the behavioral confidence that I might need, in order to, be content with where things are at, during that time, and not just selling everything and sitting on the sidelines for the next decade and watching the next, decade bull run up take off.
I would do again what I did last time, which is to say we discussed this. We had an explicit discussion about what you would do, how you would behave when this happened. Not if it would happen, when it would happen. I told you the day would come. I didn't know when, I didn't know why, I didn't know how long it would last, but it was coming and I told you so. And you said you understood that, and you said that this is what you would do when the day came. And here's your signature on the document that says that. So here's the day. And now you're asking me what to do. Well, you've already told me what you were going to do. You've pre-committed to a certain behavior. And if a plan's not even worth the paper it's written on, and you're literally not prepared to follow through on the plan, then why did we engage in the exercise in the first place? The question becomes, it's a bit rhetorical. But on the one hand, certainly you should not be hiding on your desk as an advisor. It's been said that it's in bull markets when advisors make their money, and it's in bear markets when advisors earn their money. And this is now a time for you as the person giving advice to the client to say, look, we were ready for this. We've got it all mapped out. You shouldn't even be asking me what to do. You should be pulling out your investment policy statement, or if you don't have one, your KYC, your know your client form. But at any rate, it says that your asset allocation will be X and that your risk profile will be Y. And all we're going to do is we're going to recalibrate what you still have to fit in within those parameters that we've memorialized from the get go.
Yeah, no, that makes total sense. I think with investing, all too often, everybody thinks that they make investment decisions based upon logic and fact, but the truth is they don't. What they actually do is they make decisions based upon emotions, and a big part of emotions is fear, right? And so I gave you an example of a time period of my life during the global financial crisis. Now we fast forward now, okay, to March of 2020, okay. March of 2020, specifically to the date, it was the 16th of March. Okay. Why do I know that? It's one of my son's birthdays, right? And I remember on that day, everything was plummeting. This is in the aftermath of, COVID, and stocks are, weighed down, and losses are getting exacerbated. And, they even halted, they halted the index.
It was a Monday, I remember, because a lot of people who because of COVID were sent home on Friday the 13th of March. So the 16th was a Monday. I remember.
You got it. And so, because of my lessons learned, during the global financial crisis, I saw that day as a buying opportunity. And thankfully, I had dry powder sitting on the sidelines. So I understood one thing. Number one, I may be trying to catch a falling knife, but if I do, I hope I catch it on the handle. And that's exactly what I did. So on March 16th of 2020, I deployed a lot of my dry powder into stocks on that day, and I'll never look back. Most of those stocks are up now 100 to 300%. So just kind of curious, again, you kind of have the tale of two extremes. You have the guy that's, hiding under his desk telling, his clients like the sky is falling. And then you have that opportunistic investor out there, a decade and a half later that kind of learned from, the GFC, right? Now I'm in a position where I'm going to capitalize, on the downturn. So just kind of curious to know what your take is on, the tale of both of those two extremes.
I would not portray. I would say good decision making. And my podcast is called Make Better Wealth Decisions, and decision making is predicated on having a plan and sticking to it, and doing what you say you're going to do. So I would say that doing what you did, rather than talking about catching a falling knife, I would just say is purposeful. You had a plan. you had a pre-agreed, this is what I will do in a certain circumstance, and this is what my risk profile is, and this is what my allocation will be to reflect that profile, and I will act accordingly. And so I don't I personally don't feel comfortable calling it being opportunistic. That's the word you used. I wouldn't use that word. I would just say I'm being principled. I'm doing what I said I would do. I'm showing intellectual integrity and following through on the process that I had in place all along.
That's great. Well, I appreciate that feedback, and I'll remove myself from the microscope at this point, and I'd like to take a wider look at the current market state of the markets as of this podcast. It's July 14th of 2025. We're looking at the back half of 2025, and would love to learn a little bit more about kind of your outlook for the rest of this year, moving into 2026, and specifically what macro factors are going to be the most impactful, whether that be, discussions of wars or rumors of wars, the tariff discussion, higher interest rates for potentially longer, sticky inflation, those types of things.
Every single thing that you mentioned is a factor. And so now it becomes a question of how much weight you ascribe to each of them. My primary concern right now is tariffs. There are other concerns like debt levels and people that are overconfident on the investing side, because whenever markets head south, people act as though they never saw it coming. And given where valuations are right now, that no one would be credible in saying that, because valuations are extremely stretched, and you should not get tumbled for whatever reason at whatever point in time. But to answer your question, the thing that concerns me the most is tariffs. I believe that if they are in fact put in place on August 1st, and if they remain in place at whatever level, it will be exceedingly disruptive. It will be inflationary, and I believe it will likely be stagflationary, which is to say that not only will inflation persist at a higher level than people have grown accustomed to in the past 3 or 4 years, but furthermore, well, 3 years. But furthermore, that the economy may very well stagnate and even go into reverse. It may contract, and we haven't had an economy that has been explained by stagflation, that has seen stagflation in half a century. And you and a lot of people listening today will have probably never experienced it. They will have read about it in textbooks, but they've never probably had to live through inflation. People have lived through the global financial crisis and remember it. People remember the COVID crisis and they knew they came out of it. And fortuitously, central bankers and national governments did a good job of dealing with both the health crisis and the economic crisis. Stagflation is a much, much tougher nut to crack. And if we get into a situation where we have to deal with stagflation, it could be prolonged and painful. And we won't be able to have governments and central banks bail us out because there's no easy solution. Because the problem with stagflation, you'll know the Federal Reserve has a dual mandate for full employment and stable inflation. Well, if you raise rates, you cut off and you stop inflation, but you minimize employment. And if you lower rates, well, then employment might be better, but then inflation takes off. So whatever you do to solve one half of the stagflation problem, you exacerbate the other half, which makes it a very difficult problem to fix.
Yeah, it's definitely a balancing act, that's for sure. So, when I think about, that prudent investor out there, given the lens of what you just described, you really got a couple of different roads to take. You can either choose to, double and triple down in the public markets, Wall Street investing. You can, look at alternative, investment strategies, right? You could maybe choose to become a small business owner. You can invest in hard assets. You can invest in things that regularly produce cash flow. What's kind of the prudent approach, in the event that inflation remains, sticky for longer and this potential of stagflation, or that discussion, starts to accelerate.
You've mentioned two or three of them. So first off, don't put all your eggs in one basket. So don't bet the farm on any one product or strategy or asset class. But beyond that, I would say it would be wise, in my opinion, to increase your exposure to hard assets, to increase exposure to alternative assets, and to look for, if you're going to have traditional assets, look at cash flow, which will hopefully be able to survive rocky times that, instead of lasting a few weeks or even a few quarters, which is what most people are used to, might last a few years. And you need to be able to be resilient enough to skate through that and not have to worry unduly about how you're going to pay your bills.
I'm Zach Haptonstall, CEO and co-founder of Rise 48 Equity. Our goal is to help you protect and grow your wealth by investing in large multifamily apartment buildings. We do all the work as far as sourcing these large apartment buildings from the brokers, doing all of the on-site management with our vertically integrated property management company, doing all the renovations with our vertically integrated construction company. We completely rebrand the exteriors. We will renovate the interiors to our full platinum level scope, which increases the value of the asset to get that profit margin for the investors. If you'd like to learn about how you can partner with us on these exciting opportunities, and go to our website and set up a call with our team.
Yeah, makes total sense. Let's talk about the, advisor investor friction that sometimes exists out there. I explained my kind of story, back during the global financial crisis, but from your experience, in the space, what's the biggest challenges that advisors and investors face when trying to work effectively together?
There can be many, and it should be said that there are advisors come in all shapes and sizes in terms of what they're licensed to sell and their specialization and the services they offer. And investors come in all shapes and sizes. You have young and aggressive, and middle-aged and ultra-conservative, and retired, but little old ladies on a fixed income, and a whole gamut. So yeah, it would be very difficult to give you one generic one size fits all bit of advice, but I would say the thing is you need to customize the relationship. And I think the way you customize is by asking more and better questions so that you understand, as the investor, as the person who would hire an advisor, okay, what services do you provide? What should I reasonably expect in terms of a rate of return? What planning can be done to help me to maximize my government deductions and my entitlements and so forth? And what should I expect from you in terms of contact? Will I be getting emails? Will I be getting newsletters? Will I be getting a phone call? Do we have face-to-face meetings, even if it's on Zoom? And as long as the advisor and client can agree on what the expectations are, they should be able to mutually negotiate how to fulfill those obligations and those expectations. And there will always be the odd problem here and there, and people are human. Both advisors and investors are human, so there might be the odd little hiccup. But as long as there's goodwill and good faith, there's no reason why a good relationship couldn't go on for the lives of until one of them dies, sort of thing. It should last forever.
Yeah, that makes total sense. And I'd like to maybe unpack a little bit now, about your book, specifically the bull shift one, which certainly catches anybody's attention when they read the title of the book. Would love to know a little bit more about kind of, what the reader is going to gain, from a knowledge based perspective, or what's maybe one or two different takeaways that you hope that the reader will come away with, if they choose to read your book.
Good for asking. So Bullet Drift was I started writing it. I didn't realize I was writing a book. I just started writing because it's my cathartic way of dealing things. I started writing Bull Shift when we were all sent home as a result of COVID. March of 2020. I'm home. I'm collecting my thoughts and I'm writing things out. Didn't realize I was writing a book at the time, but it ended up becoming a book. And the idea is this: the industry, the financial services industry, which is a wonderful industry. I've spent my entire career, more or less, since I was 30, doing this, and it's lovely. And it's a fantastic industry. So I don't want to sound like I'm anti-financial services industry, but like any industry, there are skeletons in closets, and there are things that can be done to make it better. And one of the things that has always concerned me, it's sort of like the Bobby McFerrin "Don't worry, be happy" approach. It's always don't worry in the take a long term view. This will be fine. And in my view, you would be better served if you say, well, look, I don't know when the bad times are going to come. I don't know what they're going to look like or how long they're going to last, but they're going to come. And the industry gives that narrative short shrift because being optimistic is good for business. It's very difficult to gather assets when you tell people, well, we've got to prepare and hunker down for a possible bear market that could last a long time. It's much better to say, hey, markets are already up whatever percent in the first half of 2025. And the train's leaving the station. You better leave now. You better get on the train and invest your money right now and try to get those returns as much as you can while you can. And it's not, I don't want to say that it's entirely bad, but it's entirely predictable. And although that's probably good advice 4 times out of 5, maybe even 19 times out of 20. The point is, that's the advice you get from the industry pretty much 100% of the time. And surely to goodness, there must be some times when you need to be careful and where you need to be mindful of what might be happening and where you need to build portfolios that are a little more resilient. I'm not suggesting hiding under your bed, doing the thing that we talked about 5 minutes ago, Jeremy, where we talk about maybe repositioning more toward hard assets and more toward alternatives so that if in fact hard times come, we can withstand them and then we can continue with confidence. The best portfolio is one you can stick to. And so I would prefer people in the second half of 2025 recalibrate their portfolios to something they can stick to rather than going full bore into a viewpoint that they can be aggressive and then in the end they find they don't have the stomach to stick with it. So bullshift talks about how the industry shifts your attention to make you feel bullish, and it talks about the dozens of behavioral biases that we all have. Advisors have them as well as clients to help people be more mindful of those biases so they can hopefully nip them in the bud and be more purposeful in their decision making.
Yeah, I appreciate the breakdown of that book. And just out of curiosity, is it out on Amazon, Audible? Where can our audience find it?
On Amazon and all. Yeah.
Good. Well, I know a big buzzword right now is, artificial intelligence or AI. So I'd be remiss not to ask you specifically about, how you feel, things like AI driven, analytics or robo platforms are changing that advisor client dynamic.
I believe mostly for the better, but like anything, it's disruptive. So whenever a new technology comes in, it disrupts the business model that carried sway for, in this case, a generation or two. And I believe it's good that it gives people choice. So if you're the sort of person who has the focus and discipline to do it yourself, AI might allow you, and a lot of younger people are choosing this, it will allow you the opportunity to do that. If, on the other hand, you're of a certain generation, and the color of my hair will tell you what generation I'm talking about, you will find AI to be a bit threatening and scary and bewildering. As a result, you'd prefer to work with a human being. I think the two of them, between the two options, working with a human and working with AI, and frankly, there's also a bit of a cyborg option where the human uses AI-enabled software to do financial planning, for instance. Um, I think the market does a good job of segmenting itself, and you have to know yourself and decide which platform you, as an investor, would like to work with. And my experience is that about over 90% of people choose correctly, which is to say, if you're working as a DIY investor, as a do-it-yourself investor, and or with AI or through some sort of a robo platform, that's probably the right thing because you've probably got the right disposition for that. And if you're working with an advisor, that's probably because you need an advisor to do that. So I think it's good that we have both options because it democratizes investing to allow people to choose however they want to have their investing experience way that fits them and meets their needs.
Yeah, John, I really appreciate that breakdown, and I'd like to now throw you a bit of a curveball question here, which is completely off the topic, but it's a two-part question. The first question is, what's your favorite U.S. football team? And second part of that question is why?
Vikings. I've been a Minnesota Vikings fan since Super Bowl seven. So I was just a kid, and Super Bowl seven was on, and my cousin was rooting for the Miami Dolphins. So I always just I'm a contrarian, so I became a Vikings fan at a very young age.
That's great. Well, we appreciate your fan support there. I guess a follow up question to that is: do you feel as though the Minnesota Vikings are a cursed football team?
Yes.
Perfect. Well,
Did you not understand? It's very short, and where I live very close to Buffalo, and so the other cursed Buffalo Bills. But there are two franchises that are cursed in the NFL.
that's right. That's right. Well, we appreciate your support and we look forward to the future because guess what? There's always next season, right?
That's right.
So that's great. Well, good. What would maybe be one or two different ways, John, that our listening audience can, connect with you more outside of course, grabbing a copy of your latest book, Bullshift?
So the other thing is, I would love it if people were interested in talking more about decision making and investor behavior and the environment that we've been talking about in 2025. If they would give a follow to my podcast, which is called "Make Better Wealth Decisions." Make Better Wealth Decisions. It's on all platforms. It's on Spotify, it's on Apple iTunes, and it's on YouTube. It's funny because I'll tell you, I started writing it in 2020, as I mentioned, and here we are now, more than 5 years later. And I was originally afraid that the book, when it was released, which was January, 2.5 years ago, that before it was being released, I was afraid that by the time the book came out, it would be too late, and markets would have imploded. And my message of be careful, pump the brakes, build more resilient portfolios, think about your behavior, would have come out too late. Well, now I actually think the book came out too early, because it's been 2.5 years since the book came out, and it's recency bias. People think, well, whatever has happened in the recent past is what I should reasonably expect for the future. And because we haven't had a major market drawdown, people are now not expecting a major market drawdown. And bear markets have not been eradicated. We'll have them at some point, at some time. I don't know when, I don't know why, but my concern is that investors to be naive, accepting, whistling past the graveyard, overly optimistic, hubristic. And so the point that I would make is I'm not asking you to do anything other than to revisit your risk profile and your asset allocation in your portfolio now, to see if changes might be needed, and they may not be. But don't assume that everything is fine, because everything has been fine for the first half of 2025. The past is not necessarily prologue.
Yeah, it makes total sense. And we will definitely include the links in the show notes for this episode. And something further tells me that your book will always be relevant, now and into the future. So kudos to you for writing it. John, this has been a wonderful conversation. Thanks for the tremendous value that you've brought our listening audience today.
My pleasure. All the best to you.
And listeners, thank you again for jumping into yet another episode of The Freedom Point. We look forward to having you join us on the next episode.
Thank you for hanging out with us today and for listening to the Freedom Point podcast, powered by Starting Point Capital. This show is for entertainment purposes only. Nothing said on this show should be considered financial advice. Before making any financial decision, please consult with a professional. This show is copyrighted by the Freedom Point podcast. Written permissions must be granted before syndication or rebroadcasting. If you're interested in connecting, you can find contact information at startingpointcapital.com.